This video will be our discussion about accounts receivable and primarily allowance for doubtful accounts. So accounts receivable, if you look at the definition or kind of the guideline of what accounts receivable is supposed to look like on our balance sheet, it's supposed to approximate the cash we're expecting to receive from customers on credit sales. So if you think about it, AR, just the AR account, represents all the money that's owed to us. But the reality is we're not going to collect every single dollar that's in AR for a number of different reasons. So you can see that I have three things listed here on this first slide, things that we might need to reduce accounts receivable on our balance sheet by. The first is the most common, allowance for doubtful accounts. So we're going to show our accounts receivable on our balance sheet, and then we're going to say less allowance for doubtful accounts, the AFDA account. You guys should remember that from Accounting 1004 and Accounting 1011. But effectively what that represents is a reduction in our receivables for the amounts that we assume or we estimate customers won't pay us, right? It's not realistic to assume that we'll collect every single dollar that's outstanding, because there will be some people who don't pay us. The other two reductions are new this year. You've all heard of cash discounts and sales returns and allowances. You know what those are. But you actually, the text this semester discusses the need to actually allow for those things. So you need to allow for cash discounts and you need to allow for sales returns and allowances. Think of sales that occur right at the end of a month, right? If we offer cash terms to 210 net 30, or if they're allowed to return some of the goods within a set number of days, well, there's a chance that those sales that occur right at the end of the month, we might not collect all of those because customers take advantage of discounts or they return some of the merchandise. So when you read through the text, you'll notice that they talk about the need to actually create allowances for those two items as well, not just AFDA. So the cash discount, the allowance for the cash discounts and the allowance for the sales returns are also contra accounts to your receivables. So theoretically, you could have accounts receivable on your balance sheet and have three contra accounts reducing it. One for AFDA, one for cash discounts, and one for sales returns and allowances. I would like to spend some time in this video focusing primarily on AFDA. It's the most common contra account to your receivables. It's the one that you'll be exposed to most often, okay? Pretty much everybody at some point, if you move on in accounting, will see an AFDA account. And like I said, whenever we extend credit to someone, there will be some level of uncollectible accounts. It's almost inevitable, okay? So what expense recognition requires is that we estimate for these bad debts so that we can expense them in the same period that we generate or record the revenue. So if we record revenue in 2009, we can't wait until sometime in 2010 when we write off the account to recognize the expense, because then the revenue's in 2009 and the expense is in 2010. It doesn't work. So what we need to do is we need to match that expense to the revenue in the same period. That's why we have to estimate for allowance for doubtful accounts. And there's two methods that are used in the text. You should have seen both of these before, okay? They're both perfectly viable. The first is the income statement approach, and this is expressed as a percentage of credit sales. Okay, and they call it the income statement approach because you're focusing on sales. And sales is obviously an income statement item. So when you're doing AFDA, you're going to get a whole bunch of numbers given to you, and then you're going to calculate something. That's going to be your first step. Let's calculate something. So if it's percentage of credit sales method, I'm going to take my credit sales times the percentage uncollectible, and I'm going to come up with a number. Right? You'll do the same thing with the second method, the aged receivables method. You're going to get some numbers, you're going to do some calculations, and you're going to come up with a number. The hardest part is determining what does that number represent. And it can be one of two things. It can either be your bad debt expense, and if it's your bad debt expense, it goes right to your journal entry. The second thing it could be is your balance in your AFDA account, in your allowance for doubtful accounts. So in the first method, we're doing the income statement approach. We're doing percentage of credit sales. We're focusing on sales, which is an income statement item. And if you think about, I said the number that you calculate could be one of two things. It could be your bad debt expense or your AFDA. Well, logically, if we're focused on the income statement, bad debt expense is on the income statement. So when doing the income statement approach, when doing percentage of credit sales, that number that you calculate is your bad debt expense. It goes right to the bad debt expense journal entry. You ignore the AFDA opening balance. It doesn't matter. So when using percentage of credit sales, you calculate a number and it goes right to the journal entry. No adjustments are required. All right? That's different than the balance sheet approach, which uses an aged receivables listing. So aged receivables listing would look like categories of receivables. So 0 to 15 days, 16 to 30 days, 31 to 45 days, 46 to 60 days, and so on. And then in each category, you'll get a dollar value. So from 0 to 15 days, we're owed $150,000. Beside that, you'll be given a percentage that's uncollectible. So you'll be calculating out what amount, you'll be calculating out an amount based on each category. Then you add them all up, and again, you come to a number. So remember, I said you're going to calculate a number. The math is simple. But when you calculate that number, we have to determine what that number represents. And it can be one of two things: your bad debt expense or the balance in the AFDA account. Well, if you think of the balance sheet approach, we're focusing on receivables, which is on the balance sheet, and AFDA is also on the balance sheet. So when we calculate a number under the aged receivables, you're not calculating your bad debt expense, you're calculating the closing balance in your AFDA account. So your bad debt expense is a function of the number you calculated, right? The number that should be the closing balance, subtracted by or lessened by the amount that's already in AFDA. So if we're using the aged receivables approach and we calculate a number that says $16,000, that $16,000 is what I want to see as my closing balance in AFDA. To figure out my bad debt expense, I have to subtract what's already in AFDA from the $16,000. So let's assume that there's already $10,000 at the beginning of the year sitting in AFDA. Well, I calculated that the balance should be $16,000. So my adjustment to get from $10,000, the opening balance, to $16,000, which is what I want in the closing balance, is a $6,000 adjustment. So my bad debt journal entry is a debit to bad debt expense for $6,000 and a credit to AFDA for $6,000. Okay? So why don't we look at an example really quick right now. Okay, so here's a practice AFDA question. Okay, I've given you some common information. The opening balance in the AFDA account is $4,000 and net credit sales for the year were $1.86 million. Situation 1 says, assume the company uses the percentage of credit sales method to calculate bad debts expense at a rate of 0.5%. Provide the entry at year end for bad debts. So right away you should be telling yourself, I'm focused on percentage of credit sales, so whatever number I calculate here is going to be my bad debt expense. So how do I deal with this? Well, it's percentage of credit sales, right? So all I do is I take my bad debts expense is a function of my credit sales times the portion that the question said was uncollectible. They said bad debt expense was 0.5% of 1.86 million. Now, if you use a calculator, don't forget 0.5% is 0.005, not 0.05. Okay, so 1.86 million times 0.5% means that the number we come up with is $9,300. And we know that because we're using the percentage of credit sales method, that $9,300 can go right to my journal entry. I ignore what's in AFDA. Because I'm focused on the income statement method, that number becomes my expense. So my journal entry at the end of the period is a debit to bad debt expense for $9,300 and a credit to AFDA for $9,300. Okay? So again, percentage of credit sales, we're focused on income statement, so the number you calculate is your bad debt expense. There's no adjustment for the opening AFDA. Okay? Let's look at situation 2. Situation 2 says, assume the company uses the aging of accounts method to calculate, and that should say bad debts expense, but bad debts expense for the year. The following aged AR trial balance is provided. So this is an aging of accounts. This is an aged receivable listing. So from 0 to 30 days, our customers owe us $150,000. From 31 to 60, they owe us $47,000. From 61 to 90, they owe us $25,000, and 90 plus, they owe us $6,000. And I've given you the uncollectible percentages here. So your responsibility, and you guys as accountants, your first instinct is going to be like, oh, I've got two numbers here, I'm going to start calculating. And that's totally fine. The number that you're calculating, okay, it's not necessarily bad debts. I'll just call this the calculated amount, okay? We're going to take 150,000 times 0.1%. And again, that's 0.1%, so that's 0.001. That's $150. 47,000 times 5% is equivalent to $2,350. 25,000 times 10% is $2,500, and 6,000 times 100% is obviously $6,000. So when I add all those up, I get to $11,000. Okay? What you're calculating here is the number that you want to see in your AFDA balance. So this $11,000 is what should be in my AFDA balance. And if you struggle with it, draw the T account out, right? So to get the adjusting entry under this method, we have to consider what's already in the account. So my bad debt expense, right, is a function of the calculated amount, which is $11,000, subtract the opening AFDA, which, if you scroll back up, is $4,000. So we already have $4,000 in the account. We need it to be sitting at $11,000 based on our aged listing. So what's my journal entry? What's my bad debt? Well, 11,000 minus 4,000 means I need to post $7,000 in bad debts expense. Because once I do that journal entry to record that, my closing balance will be at 11,000. So notice the difference between the two, right? And here's that journal entry. We're still debiting bad debt expense and crediting AFDA, but notice the difference, right? In the first example, the number that we calculated went right to the journal entry. In the second example, the number that we calculated was adjusted for what was in the opening AFDA to get a net figure. Okay, and that goes to the journal entry. And don't be afraid if this gets reversed, because if we had already had $15,000 in this account and not $4,000, then we would have had to have debited AFDA and credited bad debt expense for $4,000 to get it to balance. Okay? So that's how the two methods work. Percentage of credit sales, the number you calculate goes right to the journal entry, and if you're using the aging of accounts method, the number that you calculate is adjusted for the opening AFDA balance, and then the difference goes to your journal entry.